Hey everyone, Arindam here. Welcome back to my channel. Hope everyone's doing fine. So in the last video, I talked about as to why you should consider including gold in your investment portfolio. And in this one, I'll be talking about the 5 ways as to how you can do that. So number 1 is physical gold, that is you can purchase physical gold. Then you can go ahead and purchase digital gold, or you can go ahead and invest in gold ETFs, which are known as exchange traded funds. Then you can invest in gold mutual funds. And the last one is you can invest in sovereign gold bonds. So coming to purchasing physical gold, for this you need to go to a gold shop and buy gold bars or something of that sort, I guess. In fact, I'm not even sure as to which shop you should go to in order to buy physical gold. And to be frank, I cannot be bothered much because buying physical gold and storing them in a safety vault, I guess, in today's times does not make much sense at all. So without wasting much time on this part, let's move on to the next section, that is buying digital gold. Now this is the modern and the better version of buying physical gold. Here you pay your money online to any company who is offering to sell digital gold, and that company will buy physical gold on your behalf and store them securely. So in this case you don't have to get bothered with the storage and the security of the gold that you are buying, because the company that you are buying the digital version of that from is taking care of all those factors on your behalf. So as far as you're concerned, the gold that you're buying is represented in a digital form. So let's quickly go over the pros and the cons of buying digital gold. So among pros, number 1, there's no hassle in terms of storage and security of the physical gold. The minimum amount that is required for investment is very low, so you can invest as low as rupees 100 in this case. And the number 3rd point is conversion to physical gold. So the digital gold that you're buying, if you want, you can get that converted to physical gold, and the company will deliver the physical gold to you. Now coming down to the con, so this first point could be a disadvantage for you, or it may not be, depending on how you see it, but it needs to be mentioned. So this process of buying digital gold is something that is not regulated by any body like SEBI or RBI. Now that does not mean it isn't safe. The companies who are managing the gold on your behalf, they are very reputed and they are very good companies, and they do their internal audits and they do their diligence from their part to the maximum. But this is something I think which you should be aware about when you're going to buy digital gold, that it's not regulated by any body or any government institution or organization. And the second disadvantage are the charges. So whenever you go on to buy digital gold, there are various charges which the company who's offering you that digital gold incurs on your behalf. So we have a storage cost, we have transportation, we have security, we have insurance. All these are incurred by the company, and obviously they'll be recovering this from you. So as you can see here, I'm using Paytm to buy digital gold. I'm buying gold worth 50 rupees. So after levying 3% GST, I have to pay 51.5. Now after buying 50 rupees worth of gold, as you can see, the value of gold showing in my account is 48.52. So the difference between the buying and the selling price is known as spread, and we have to bear this whenever we buy digital gold. So that was digital gold and the pros and the cons associated with it. You can go on to buy digital gold from platforms such as Groww, Paytm, Upstocks, Google Pay, etc. Now moving on to the next part, that is gold mutual funds. So these are like normal mutual funds only, but in case of the normal mutual fund companies, the money that they collect from you, they invest those in equity, debt or short-term securities. But in case of gold mutual funds, the money that you pay to the mutual fund companies, those companies invest those in most of the cases in gold ETFs. Now what are gold ETFs? I'll be explaining that in the next section. So let's check out the pros and cons of gold mutual funds. Now for pros, you have monthly investments. Now since this is a mutual fund, you can invest on a monthly basis, like in the case of any other mutual fund, which is known as SIP. So that is something which you can do here. The next pro is it is regulated by SEBI. Then again, you can start with as low as rupees 100 in the case of digital gold. So that's not an issue here. You do not require any demat account in order to invest in a gold mutual fund. And coming to cons, again, we have charges. Now the charges here are not that much, but if you have to compare with that of gold ETFs, they are slightly higher. So that can be considered as a con, you can say. And also there's an exit load applicable. So if you are willing to redeem your investment within a period of 1 year, in most, or I would say in case of all the gold mutual funds, they will charge an exit load from you at the rate of around 1%, I think. So that is not there in the case of the other cases. So that you can consider as a con in case of gold mutual funds. So what are the places where you can go to if you want to invest in a gold mutual fund? you can approach any of the popular brokers or nowadays. For example, we have Zerodha, we have Upstocks, we have Paytm Money. So these are all the brokers, online brokers, which you can approach if you want to invest in a gold mutual fund. Now, moving on to gold ETFs. So gold exchange traded funds are similar to mutual funds, with the only difference being they are traded in the stock exchange. So you can instantly buy and sell them like shares of any company that you do on a stock exchange. And because you have to buy them from the stock exchange, you need a demat account in order to invest in gold ETFs. Now, the money that you're paying to the companies who's managing these ETFs, those companies invest that money in actual physical and pure gold. Now, even the companies in the case of digital gold, they do actually buy gold using the money that you're paying them. But in that case, you can actually see how many grams of gold you're buying. So it will show you that you have bought 2 grams of digital gold. But in this case, you're just giving them the money, and the companies who are managing these ETFs, they are using that money to purchase physical gold. So that is how the money that you are paying them is related with the price of the gold. So now let's move on to the pros and cons in case of gold ETFs. So number one, we have it is regulated by SEBI. Then again, we have very low starting amount. So if I consider Nifty Gold Bees, which is one of the most actively traded gold ETFs, 1 unit of Nifty Gold Bees costs around ₹40. So in this case, 1 unit of gold ETF represents approximately around 0.01 grams of gold. So you can start investing with as low as ₹40. Then again, we have lower charges. The gold ETFs have comparatively lower amount of charges if you compare them to gold mutual funds. And also, there is no exit load applicable in case of gold ETFs. So among the disadvantages, the number one point that I can think about is here you cannot invest on a monthly basis, that you cannot do SIP here. Whatever investment you want to do, you have to make at one point of time in a lump sum amount. Then the second point, which is not more of a disadvantage for me, because I'll explain why. You need to have a demat account here, because again, you're buying it from a stock exchange like actual shares. But then nowadays, opening a demat account is so seamless and easy that should not be big of an issue for most of the people. And in any case, you should own equity shares nowadays. So you might as well open a demat account, because you will need that down the line. So that is not much of a con for me, but it's something that I should mention. So if you want to invest in gold ETFs, again, you can approach various brokers. So you have Zerodha, Grow, Paytm Money, these are the discount brokers. You can approach them and you can open and you can invest in gold ETFs if you want to. Next, we have SGBs, or sovereign government bonds. So this is the last avenue through which you can go ahead and invest in gold. So these are bonds which are issued and backed by the central government, and this I would say is the safest among all the options that I have discussed so far. Now these are not available for investment all the time though. These are issued by the government in specific time intervals, and you have to purchase these bonds within those time intervals that is given by the government. So in case of the last issue, that is the Series 6, which was released by the government, the subscription period was from August 30 to September 3rd, 2021. And if you had to purchase them, you had to purchase them within that specific period. These bonds are available for purchase both offline and online. So apart from the returns that you would get from the appreciation or depreciation in the price of gold, there is one more way in which you can earn from sovereign government bonds. So SGBs issue you a 2.5% interest every year, and that interest is paid to you on a half-yearly basis. So every 6 months you would get an interest of around 1.25%. So that's a good thing which is available with SGBs, and this is something which no other option does for you. Now the maturity period in case of SGBs is 8 years. So the amount that you have invested, you will be getting back that amount after a period of 8 years. Now there is an early redemption option available as well in case of SGBs. So you can do that after the completion of 5 years. So after you complete 5 years, if you want, you can sell off the investment that you have made. But you can do that only on the coupon payment dates that is available in the year. That is the dates when you get the interest from these bonds. So like I said earlier, you get half-yearly interests, so 2 times a year. So during those 2 times, if you want, you can redeem your SGB after completing a period of 5 years. Now, one interesting thing about SGB is the money that you are paying to the government when you're purchasing these bonds. The government is not actually going ahead and buying physical gold. The bonds are valued in such a way that they equal the price of gold that is there in the market at that point of time. So one bond is priced at a rate that is equivalent to 1 gram of gold, and one individual can hold bonds equivalent to maximum of 4 kg of gold. So that is one interesting fact about SGBs. So coming to the pros and cons, like I said earlier, this is completely safe and secure. So that's the number one pro you have here. Then again, there are no charges of any sort applicable in case of SGBs. And if you have to compare the returns, SGB would give you the highest amount of return if you compare with any other option available, because here you are paid an additional interest rate of 2.5% every year. And also there are tax advantages. So the amount that you would be getting upon completion of the maturity period after 8 years, or if you decide to redeem the investment after a period of 5 years, that lump sum amount that you would be getting, that is exempted from tax completely. Unlike in the other cases where capital gains would be applicable if you go on to redeem your investment. So those are the pros for you. Coming to the disadvantages, one major disadvantage I would say here is the problem of liquidity. So like I said earlier, there is a maturity period of 8 years and you do have the option of redeeming it after completing a period of 5 years. But you can only do that on very specific dates and only 2 times a year. So if you want to buy gold when the price has fallen to the minimum, or if you want to sell off your SGB when the price of gold has spiked, and if the timing does not match with what the government says, you may not be able to do that. So that is one problem which you might have in case of SGBs. Now there is one more way for you to buy and sell these bonds, that is on the stock exchange. So when you buy these bonds, from wherever you are purchasing them, they ask for your Demat account ID, and after you provide them that, given you have a Demat account, these bonds then get credited to your Demat account. So if you want later on, you can sell off these on the stock exchange. But the problem is you may not get any buyers for these SGBs on the stock exchange because these are not traded that much. So if you have these bonds worth rupees 4 lakhs and you want to sell them off, you may not be able to do that because there aren't any buyers for those. So liquidity becomes a problem here as well, even if you want to sell them off on the stock exchange. So that is something which you need to be aware about if you want to go ahead and purchase SGBs. Now as of now, these SGBs are not available for purchase because September 3rd was the last date for them. But when they are made available again, you can purchase them from commercial banks or designated post office or even brokers. And you can even go to your bank's internet banking and you can purchase them from there as well. Now out of these 5, which one do I recommend and why? There is no single answer for everyone. I would say it depends. So if you're looking for a long-term, greater than 5 years kind of thing, and you just want to invest and forget till the time it matures, I would say go with the SGB. That's the best one out there. But if you are moderately active and stay aware about the stock price and the gold prices, I would say you can go with the gold ETF. That is my personal preference as well. The reason for this is in the last video I mentioned that you should invest in gold because it acts as a hedge against the stock market. Because whenever there is a downfall in the economy or in the stock market, the gold price goes up during those times. But if you have invested in SGB and the timing does not work out for you, you may not be able to sell those gold bonds when the gold price is at its highest. So for example, last year around August, when the pandemic was at its peak, gold prices towered above rupees 56,000. And if at that point of time I had investments in SGBs, I would not be able to sell those SGBs very easily because of the timing issue. So that is one major disadvantage for me as far as SGB is concerned, and that is the reason I prefer investing in gold ETFs over sovereign gold bonds. Now as far as gold mutual funds are concerned, there are annual charges. Now they are not as high when you compare them to gold ETFs, but then gold mutual funds are investing in gold ETFs, so you might as well directly invest in the ETFs. It doesn't make much of a difference. Now you can buy digital gold if you want, but then there is the issue of that spread, which can matter if you have large amount of investments in gold. And also like I said earlier, this entire thing is unregulated. So if that is something that matters to you, you may not want to invest in digital gold. And lastly, we had physical gold, and like I said in the beginning, that's a complete no. That's not an option for you. So stay away from physical gold, and also jewelry, by the way. You should not buy jewelry if you want to invest in gold. Buy that separately for a separate purpose, but do not buy jewelry for investing in gold. So those were the different ways for you to invest in gold. And I hope after watching this video and the previous video, both of them combined, you were able to have some decent amount of knowledge when it comes to gold investment. And I hope it helps you out to go ahead and do that if you wanted to. So that was it for this video. If you like the kind of content that I am creating, please consider subscribing to my channel and liking and sharing the videos as well. And you can also drop any comment that you might have. I'll be happy to reply to them. So until the next one, take care, see you, and bye-bye.